This is Growing Wealth, and in this video, we'll be going through the dividend capture strategy, a simple yet effective strategy that can help us build a long-term dividend portfolio with minimal capital investment. Thanks to our community members at Growing Wealth for sharing this strategy. I've been optimizing its performance ever since August of 2020. And in a short span of 8 to 9 months, these are the trades that I have taken so far. I'm glad to say that overall, the strategy has brought in almost $3,000 worth in profits, which represents an average return of investment of 2.24%. These trades occur over the course of less than a week to several weeks. As you can see, some of the trades are as short as just 3 days. And some of the longer one that I've experienced so far just happened recently in January this year, and that trade took slightly more than 2 months. But on average, the trade duration is about 17.5 days, and that is about 2 to 3 weeks. I hope that these results are satisfying for your appetite. If so, watch to the end because we will be going through every minor details of the strategy in depth. And before we begin, show your support to the channel by leaving a like and subscribe to the channel. Your support goes a long way as a form of motivation for me to push out more enriching contents for you guys. Now, most of us have limited capital, and all of us wants to make full use of our capital to get as much return as possible with minimal risk. Therefore, in this strategy, we are looking at a quick entry and exit in stocks of the top dividend-paying companies, and at the same time, do whatever it takes to protect our initial capital. After capturing the dividend payout from these companies, we are going to reinvest them and build our own dividend portfolio without a single cent invested from our initial capital. This strategy is best used when you have additional capital lying around without much things to invest in, because, for example, the stocks that you are eyeing are overvalued, or maybe because you are just waiting for a greater discount to come. So to minimize risk on our part, we want to pick and shortlist only the best dividend-paying companies to invest in. We will be using these criteria. First, to ensure the quality of the dividends that the companies are paying out, we only want to invest in dividend aristocrats or dividend kings. So what are dividend aristocrats? A quick visit to Wikipedia will tell us that in order for a stock to be a dividend aristocrat, it must first be a member of the S&P 500, the broad market index that represents the US market. Secondly, the stock must have increased their dividend payment for at least the past 25 years consecutively without fail. Right, so this gives us an indication and some confidence in how strong the company is in order to meet this set of criteria. And as for dividend kings, the criteria are pushed even further. For dividend kings have increased their dividend payout for at least 50 years consecutively, double that of the dividend aristocrats. So it is an even stricter criteria, and in addition to that, it must have at least a market cap of 3 billion. Right, so another indication and confidence to us that these companies should be rather stable and strong. Alright, so therefore, dividend kings is just a stricter subset of the dividend aristocrats. And it is up to you on how strict you want to be on your own investments. For myself, I'm fine with investing in dividend aristocrats, as there will be more criteria that will help me sieve out the best of the best in this group of companies. Now, in order to get a list of companies that are in each of these groups, just go back to the previous websites that we have visited. Wikipedia is one of them, and if you scroll down, you can see a whole list of companies that are in the dividend aristocrat group. So as of December 2020, there are 66 stocks in this category. And these are some of them that you might want to take note of. To get the list of dividend kings, just simply Google dividend kings and then click on the first link over here. That should bring you to this website, and likewise scroll down all the way to the bottom. And there you have it. According to this website and their report, there are 31 dividend kings, and these are their ticker symbols. So likewise, you can take note of them and then put them into your watch list for analysis later on. Now, after selecting the top dividend companies, next we want the dividend yield of the company to be at least 2.5% or ideally 4%. Take note that we are looking at the current dividend yield, and this basically means we are taking the current stock price divided by the dividend payout from the company in a year. The reason for this criteria is because we are going to reinvest our dividends in the shares of the companies, and having too low a dividend yield will not be really worth it for our time. Take this for example, a company is trading at $100 with a current dividend yield of 4%. This means that the company is paying out $4 in dividend every year. And since most US companies pay out dividend quarterly, that is $1 per quarter. Now note that this dividend paid out $1 per quarter is per share that you own. Therefore, for every 100 shares that you own, you'll be getting $100 in dividend every quarter. In an ideal world without tax, this means that you can reinvest all your dividend for one share of the company previously trading at $100. In other words, you just got one share of the company for free. However, tax exists, and as a foreign investor like myself, our dividend will be subjected to a 30% withholding tax. This means that the dividends that I will collect from this investment is actually only $70. And this is only worth 0.7 shares of the company. If your broker allows fractional shares trading, then it's fine. You can reinvest all of your dividends for these 0.7 shares. Otherwise, you will have to hold off your reinvestment, wait till the next round of dividends before you can afford one share if the stock price is still trading at $100. And this is done so that you can invest in one share purely with dividend gains without additional capital investment. Therefore, withholding tax is the reason for this baseline yield of 2.5%, because anything less than 2.5% will generally not be worth it for our time. Now going back to our previous example, and let's apply a 2.5% dividend yield instead. This means that the company will be paying out $2.50 per year, which translates to 62.5 cents per quarter. And after taxes, that is only 43.75 cents per share, right? Translating to $43.75 per quarter for every 100 shares that you own. And you can see that even after 2 rounds of dividends, your dividend gains is only $87.50. And this means that over half a year, you'll still be lacking some dividend gains to invest in one share without additional capital. Alright, so I hope this analogy makes sense to you on our criteria of picking a current dividend yield of more than 2.5%. Dividend quality is one set of criteria. The next is to ensure that the companies that we invest in are fundamentally strong. This gives us the assurance that our investment and time in the company will be worthwhile. Therefore, we want to focus on the profitability of the company, making sure that the company is getting more and more profitable based on its historical performance, or minimally stagnant and not declining. Alright, to illustrate the example, I'll be using AbbVie, ticker symbol ABBV, as an example. AbbVie is one of the dividend aristocrats, and it is paying out its second quarter of dividends very soon. In fact, on the 14th of April. And this is one of the stock that I'm eyeing for the next trade that I'm going to get. Likewise, at a current share price of $108.52, the current dividend yield of AbbVie is more than 4% currently, which makes it a very attractive target. But let's not forget about the fundamental strength as well. In order to assess that criteria, you want to go over to routers, likewise key in the ticker symbol for the company that you want to analyze, and then go over to financials. There'll be 3 key components that we want to take note of. The first one is its revenue. In order to have the confidence that a company is being more and more profitable over the years, we want to see that for the last 5 years in its history, the revenue is making a consistently increasing uptrend. And this is seen very clearly in the revenue of AbbVie. From December 2016 all the way to December 2020, its figures has been increasing consistently and very nicely. Apart from revenue, we also want to double check this with the net income. Net income can be gotten here on the same page if you scroll down a little bit further. And for net income of AbbVie, we can see that generally it is flat. So for our criteria, this is okay, as long as it is not declining. What we want to look out for is a consistent figures over the years or a consistently increasing trend over the last 5 years. After net income, the last one that we want to look into is the cash flow, specifically the cash flow from operations. This tells us how much money the main core business of AbbVie is bringing in. And for the cash flow of operating activities, it can be gotten from here. Likewise, the trend for the last 5 years has been very nice. It can be seen from this summary graph over here. It has been on a very clear uptrend. Alright, so MV, the next target of my trade, fulfills the first criteria as well as the second criteria in fundamental strength. Lastly, we want to look at its historical stock price. We want a stock that is overall on a long-term uptrend or minimally trading sideways. This gives us the confidence that our investment in the company will be worthwhile. And in addition to the dividends that we collect and reinvest, we have capital appreciation working in our favor to grow our dividend portfolio exponentially. And I'm sure that none of us wants to invest in a company that is in a consistent downtrend, am I right? So in order to ensure that a company is on a long-term uptrend, you can simply conduct this analysis using the stockbroker that you use to trade with. So how do we look at the trend of a stock? For that, let's head back to our charting software. To look at the long-term trend of a stock, we want the overall 10-year chart. Right? And to summarize all the candles up, we will be relying on the 10-year monthly chart. Alright, so this is the 10-year monthly chart for AbbVie. From the chart, we can see that AbbVie is in a very nice long-term uptrend ever since it has IPO'd back in the year 2013. Once you see a chart pattern like this, the stock should give you the confidence that after reinvesting your dividends in it, the share price should continue going upwards in the long run. And the additional capital appreciation that you get from the increment in stock prices will be an exponential boost to your portfolio performance over the years. As a negative example, what you do not want to invest in or what you do not want to execute the trade on would be something like this. This is the 10-year monthly chart for IBM, and you can see that it is very clearly on a general downtrend. You can see that the moving averages are mostly sloping downwards. The blue line over here is the 50 moving average, and the green line is the 150 simple moving average. It's also starting to flatten out and starting to slope down. Alright, and in addition to that, you can see that where we started 10 years ago, at this price over here is much higher than where it is today 10 years later. And if the price action is confusing enough such that you cannot determine a trend directly, the simplest way would be to connect a line from the starting point 10 years ago to the ending point 10 years later, which is now. And you can see that this gives you a down sloping gradient. So from here you can see that IBM is in a downtrend, and we do not want to execute the dividend capture strategy on a stock like this. And for a stock that is trading sideways, it should generally look something like this. Right, very clearly you can see that the price action within these 10 years has been in a very tight consolidation between somewhere about $38 to somewhere around $50 for most of the time. Alright, so should you ever come across a dividend stock that has a price action like this, it is a suitable candidate for you to execute the trade on as well. Now, this is just an example, not to say that the current ticker that we are looking at, EM, is a dividend paying stock. In fact, it is the emerging markets ETF, alright? So this is just to illustrate the concept clear to you on what a sideways trend would look like for a stock. Alright, so this is the list of criteria that I have for the strategy. If you have any other criteria that will make this list more robust, feel free to include it in your analysis and shortlisting. But also share it with us in the comments below. With this set of criteria, it is time for you to do some screening and build your own watch list for your potential dividend portfolio. If you would like me to do the work for you, I'll be more than happy to as well. Just leave a like and subscribe to our channel so that you'll be updated about my personal watch list when part 2 of the strategy is uploaded. In part 2 of the strategy, we will be going through in depth the entry and exit rules for these stocks, as well as the steps that we take to minimize our risk and prevent any loss of our initial capital. I'll also be sharing some of my experiences with this strategy and the potential risk to look out for when trading this strategy. This is Growing Wealth, and thanks for watching.